Welcome to Barron's Roundtable, where we get behind the headlines to prepare you for the week ahead. I'm Jack Otter. Coming up, Wall Street on edge about the AI trade as the spending keeps soaring, but the payoff remains hard to see. We're digging into the risks, the winners, and what comes next. We begin with our expert panel on 3 things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levisohn, Megan Leonhardt, and Jack Hough. So, Ben, the market managed to eke out a gain this week after a rally on Friday. It wasn't looking so good earlier in the week.
No, there was a lot. I mean, it looked like nothing happened, but when you look at it, it's actually pretty crazy. The average move in the index this week was 1.2% each day. This year, it's been 0.9%. That gives you a little bit of a sense. It was spooked by the AI trade. Everyone's saying, oh, the AI trade is over. The Fed...
We'll talk about that later.
We will. The Fed might not cut rates in December. That freaked people out, too, and that hit risky stocks particularly hard. Things like the S&P high beta ETF. These are very volatile stocks. Also small caps, which are very tied to the Fed. They got hit, but the S&P 500 managed to finish the week up about 0.1%.
And there was more good news in that breadth improved. We've been talking about all those gains concentrated in just a few stocks. Well, Schwab reported this week that 60% of stocks in the S&P were above their 200-day moving average, which, technical people like you think is a good thing.
Yeah, that is a great thing. And, it really does feel like there's rotation going on, that people are looking at these garbage stocks that have done so well and saying, you know what? I think it's time to take profits. I'm going to go look at other stuff. And so I think the thing that shows that the best is the healthcare sector. It gained about 4.5% this week. It's now the best performing sector over the past 3 months after being negative just a little while ago. It's been pretty wild. We've
been banging the table on healthcare, so that's a good thing. So what are we looking at next week?
Okay, I'm going to interrupt because it's data week finally. Woo-hoo. We're finally getting some data. So we just heard from the Bureau of Labor Statistics that we're going to get the September jobs report. Remember, that was a little bit delayed now because of that shutdown. We're also going to get real earnings. Now, everything else we don't know quite yet. We're keeping a close eye, and fingers crossed we'll get it soon.
Go ahead.
No, I was just going to say, we had, we lived without this economic data for a while now, and the market didn't really care. I think the most important thing to watch is going to be NVIDIA earnings. That's coming Wednesday. It's going to tell us a lot about the AI trade.
Oh, yeah. October jobs report, we'll probably never get that, right?
We will get something. It may not be as fulsome as we're used to.
Okay, let's move on to the consumer. Everyone always says, that's what's holding up the American economy. Some people are starting to argue that's what's holding up the global economy is the U.S. consumer. But you're pointing out that it's not all U.S. consumers. It's a pretty narrow sliver.
No, I think the words we need to memorize at this point is the K-shaped economy. This is the term that's going around academic circles. Economists keep talking about it. I like to consider it a two-speed economy. I think that's a better term and something people are more familiar with. But essentially what I'm talking about is the fact that lower and middle income households are not doing as well. They're feeling the squeeze. And then you've got higher income households because of the wealth effect, because we've had a very strong stock market. We've got those real estate gains. And additionally, we're getting more normalization on that wage growth, and it's going to the higher incomes now. So this is creating some issues, and you can see this in things like dining patterns, for example. So when you start to look at who's doing well right now, it's actually those small independent restaurants, the full-service meal, sit down with the family, have a birthday dinner type of thing. The pullback is actually happening on fast casual and some fast food chains. So that's, your places like Wendy's and Cava. They're actually kind of struggling, and their, earnings, their stock is also taking a little bit of a hit because you're going to pull back on those lunches, on those coffees when you do have that sort of budget constraint.
Yeah, that makes sense. Retailers, they're showing some of the strain as well?
Actually, it is one of those things I want to point out that luxury, remember, those higher income households, we do have some luxury we have some
realtors and real estate.
Yeah, all of that. So retail doing really well. So like Ralph Lauren, we do have, things like Tapestry, which owns your Kate Spade, your Coach, that's doing really well with actually the younger segment. And then, of course, Hermes. I mean, it's one of those situations, you go down, Madison Avenue these days, that store is popping. It's almost like they're giving away those purses.
But actually, they're charging about $10,000 for them.
But it's not just luxury retailers. What I'm fascinated by is we're seeing stocks like Kohl's and Macy's do well. These stocks were hated, and now they're popping. I'm not sure what it says, but it might be that the K-shaped economy is maybe coming to an end.
Jack, let's go to Disney World.
Yeah.
Disney reported earnings this week. They look pretty good, but the street was not impressed.
Disney is dealing with an underperforming sequel called The Return of Bob Iger, We're at the 3-year mark since he came back as CEO. The stock is underperforming the S&P 500 by 60 points over that stretch, underperforming Netflix by 270 points, and that includes an 8% decline in response to earnings. The business is fundamentally healthy. Parks grew a little slower than expected because there's competition from that Epic universe in Florida. Streaming is growing. Legacy TV is shrinking. Cruise lines were hit by a delay with a new ship, and movies have had difficult comparisons. Although the slate looks decent, there's a new Toy Story coming, new Avengers movie coming. Basically, what's going on with Disney is this has transitioned from a growth stock to a value stock. Used to trade at a big premium to the market. Now it's 16 times earnings, which we used to call normal, but these days qualifies as mighty cheap. The company just raised the dividend by 50%, but it's still only a 1.4% yield. If we can get some earnings growth in the years ahead, maybe the stock can make a rebound, but looking pretty unexciting here.
Alrighty, 3.8 million new streaming subscribers in one quarter. That's not bad, but thank you, Jack.